Sectors that have oligopoly present interesting narratives. In few cases, the companies script a narrative of immense pricing power and guarded moats. Yet, a single plot twist, be a regulatory coup or a breakdown in cartel chemistry, can instantly turn a blue chip epic into a cautionary tale. At times, a sector boasts explosive growth potential but is populated by only a handful of listed players. In such cases, the standard rules of valuation often give way to scarcity premium and existential dread. In the concentrated markets, every minor shift in market share or a single regulatory stroke doesn't just nudge a stock price, it recalibrates the entire perceived future of the industry. The recent fiasco of Interglobe Aviations is a pertinent case in point. In the case of growth oligopoly, where absence of choice for investors leads to a massive valuation swing, stocks turn into battlegrounds of extreme sentiment. India's telecommunications sector stands as the definitive specimen of this phenomenon. Once a crowded marketplace teeming with nearly a dozen players, the telecom sector has been consolidated by predatory pricing and regulatory upheaval. It has effectively become a three-player market with two dominant private giants and a struggling third. This scarcity of listed options means that the institutional capital, like mutual funds and insurance companies, which must maintain exposure to India's digital backbone, have very few choices. When the news is good, the scarcity drives valuations to the stratosphere. When the news is bleak, the exit door is too small for the volume of capital trying to flee. The result is a sector that oscillates between being the darling of digital India and the graveyard of capital. For years, the primary force of keeping the smart money at bay from India's telecom was not a lack of growth. The data consumption metrics in India are amongst the highest globally, but a relentless storm of regulatory headwinds made everyone skeptical. The adjusted gross revenue AGR crisis was a decade-long legal battle over how the government calculates its share of telecom revenue. This dispute created a multi-billion rupee hole in the balance sheets of Indian telecom incumbents. It kept the proverbial sword of Damocles hanging over it. Investors grew wary of a landscape where the rules of the game seemed to shift after the match had already started. The fear was that any operational gain made through efficiency or tariff hikes would simply be taxed away by a cash-strapped government. This perceived regulatory risk premium kept valuations depressed even as the country underwent a massive smartphone revolution. However, the tide has recently shown signs of turning. The recent positive developments regarding curative petitions and potential relief for Vodafone Idea has sparked a ray of hope. So what has changed? For years, the market had priced in the duopoly risk in telecom sector. Investors feared that a collapse of the third player, Vodafone, would trigger a harsh regulatory crackdown to prevent a total monopoly. The potential recalculation or deferment of dues have breathed life back into a three-player market. This shift in sentiment is crucial because it suggests a transition from a combative regulatory environment to a supportive one. Amidst this volatility, Bharti Airtel has emerged as the dependable choice for long-term investors. Unlike the frantic survival stories elsewhere in the sector, Airtel has successfully pivoted to a narrative of sustainability. The company has demonstrated a rare ability to generate positive free cash flow despite the eye-watering capital expenditure required for 5G rollouts. More importantly, its return on capital employed has begun to trend towards levels that actually exceed the cost of capital. This is a milestone that was a distant dream during the price wars of 2016 to 19. By focusing on a premium user base and diversifying into home broadband and enterprise services, Airtel has insulated itself from the commodity trap. For long-term investors, Bharti Airtel represents a clean way to play the Indian consumer's digital upgrade without the high-octane balance sheet risk associated with its competitors. Yet, even in a recovering sector, the path to riches is littered with traps. The most prominent risk is the volatility in the average revenue per user, popularly called ARPU. The entire bullish case for Indian Telecom rests on the assumption that ARPU will eventually cross the Rs 300 threshold. However, this is not a linear journey. In a price-sensitive market like India, every tariff hike risks SIM consolidation. So users drop their secondary connections or there's a slowdown in data upgrades. If the projected ARPU growth stalls due to economic pressures or a renewed fight for the bottom of the pyramid subscribers, the current valuations could face brutal correction. So investors must realize that they are betting on the consumer's willingness to pay more for services that they have grown accustomed to receiving at bargain prices. Therefore, despite the buzz around the sector, investors must maintain a healthy skepticism. There is a visible trend of investors lapping up telecom stocks with the hope of catching a pre-listing rally ahead of the much anticipated Reliance Jio IPO. The logic seems simple. If Jio lists at a massive valuation, it will re-rate the entire sector. However, this ignores the institutional fund flows into the sector. Mutual fund managers often buy incumbent players as a proxy. Once the Jio IPO hits the market, there is significant risk of capital rotation. Institutional money may prune their holdings in existing telecom stocks to make room for the new market leader. In doing so, they potentially leave retail investors holding stocks that have lost their scarcity premium. Ultimately, the Indian telecom story is a masterclass in the risks and rewards of concentrated sectors. It offers a front row seat to the digital transformation of a billion people. But the valuations reflect the tolerance for high stakes litigation and unpredictable policy shifts. The recent relief for Vodafone and the operational excellence of Bharti Airtel provide a much needed margin of safety. But the sector remains a high beta play. Retail investors should remember that in an oligopoly sector, the businesses don't just compete with each other, they compete for the limited attention and capital of the market. Betting on the long-term prospects of Indian telecom giants requires more than just a bullish outlook on data usage. It requires the discipline to distinguish between a structural turnaround and a temporary sentiment swing fueled by IPO hype. Hope you like this video. Thanks for watching.